Um, I'm here to give the big picture, but in order to understand the big picture, we also have to understand a little bit about the atoms that make up the big picture. So I'm going to sort of give you the big picture and then help you try to understand why the big picture didn't probably work out the way some of the major policymakers thought it would work out. So here we are. So this is a macroeconomic environment for those of you who have taken economics. Macro, that's the big picture. Micro, that's the little picture. And generally, macroeconomics looks at changes in big things like government expenditure or consumption or business investment or international trade. But to do this, we have to make some assumptions about what's going on below the surface, about how consumers behave, how investors behave, how international competitors behave, how people compete in the marketplace. You know, how come that Toyota does better than General Motors? Questions like that. Or why people decide that they're going to buy a house or that they're going to leverage themselves by putting nothing down and just borrowing from the banks. I mean, those are all assumptions that we have to make in order to understand what's happening in the big picture. And they make spending decisions, and that's really, it's those spending decisions below the surface that changed, particularly in the last 4 or 5 years, that actually got us into the trouble that we find ourselves now. So the current crisis in many ways caught particularly policymakers by surprise, because a lot of those policymakers came to schools like NJIT or Yale or MIT or Stanford or or Princeton in the case of Mr. Bernanke. And basically they learned a certain kind of economics and certain kinds of assumptions, and they continue to apply those concepts and those ideas in generating policy. And if you might remember that a year and a half ago, say, Mr. Bernanke said, you know, the subprime mortgage crisis was going to be contained and there were no problems, and this was just, you know, this was just kind of a blip in terms of the global financial system. And of course, we now know that that wasn't true. So why wasn't it true? Well, here are some key assumptions that those of you who might have studied macroeconomics or microeconomics might have made. And one is that consumers spend out of disposable income. You only can spend up to what you make, at least for the economy as a whole. And generally that was true going back, you know, decades. But in the last 4 or 5 years, consumers started to basically take out particularly the money from what they saw as the appreciation in the value of their homes through refinancing, and then spent that money. And in fact, some people would run up credit card debt, and then when they got to a point where the banks weren't willing to give them any more, they maxed out their credit cards, then they refinance their house, pay down the credit cards, and start the whole system again. So actually between 2005 and 2007, roughly 10% of U.S. consumption was not out of disposable income, but in fact was out of equity that people took out of their homes. And that may not sound like much, but the U.S. economy is so huge that 10% is roughly $1 trillion. And to give you some idea of what $1 trillion is, that would be like China. So you take all the people in China and their total consumption, that's about $1 trillion. So that's a big number. So it's like, and of course people can't do that anymore, so it's like we just took $1 trillion out of the global economy. And of course that $1 trillion has other consequences, because if people aren't buying homes, then they're not building homes, so people aren't buying lumber, and they're not buying furniture. The people who are manufacturing those things, whether any place in the world, they're not producing them, so they get laid off, so then they don't consume. So that $1 trillion actually tends to get multiplied through the system, and so the actual impact of this could be, in terms of the global economy, could be upwards of $2 trillion. A part of the assumption here that consumption would just sort of continue was that we've moved to a service economy. And a service economy is much more stable, or considered to be more stable, than a manufacturing economy. People less likely to get laid off. But what happened is that yes, we did shift to a service economy, but that service economy in and of itself got tied back into the housing sector, and so became vulnerable to rises in interest rates that the Federal Reserve pursued starting in around 2004. So those rates got higher, then people couldn't afford to buy homes. The housing market went down. People could no longer go in and tap their home equity, and therefore consumption started to fall, including for services. So what happened is that housing and consumption link undermined that assumption. And then finally, there was a general assumption that financial markets are very efficient, and as Mr. Greenspan said, it would be efficient in spreading risk around from those who didn't want it to those people who could handle it. But we know now from the rescues that, in fact, risk became highly concentrated, and so when the market went down, particularly for mortgage-backed securities, a lot of big financial institutions ended up holding the risk, and that's really the major source of the meltdown. So all these assumptions turned out to be that were underlying the policymakers' assumptions in terms of the macroeconomic environment turned out not to be true. And then once we knew that, then of course the economic policies become quite different. And I might just say one other thing about the efficient markets is that if the efficient market also assumes that you have some sort of standard product. So one of the reasons you can sell your IBM stock so easily online is that every share of IBM looks like every other share. The problem with the mortgage-backed securities as the industry, and we'll hear more of that from the other panelists, as they divided these things up and sold off pieces, including maybe the first 3 years of cash flow, people stopped paying, then the people who bought that particular security have now got a worthless piece of paper. And the people who are holding the mortgage may also have something that's worth a lot less, because instead of being something that can just be sold, any of you who have tried to sell a house know that it can take months, so it's not really a liquid asset. So again, one of the assumptions for a lot of the paper that was being distributed was that there was a liquid market for this, and in fact there wasn't. So a lot of assumptions that were made in terms of traditional ideas about how the economy and how financial markets function turned out not to be true, because there had been change in the institutional environment. And I will stop here and turn it over to my colleagues.